This question 2004 paper 2 question 2, it looks very complicated. Okay, then okay, you see here you are given all the following additional information, and okay, so now let's see what the question wants. So part A, prepare a manufacturing account for the year ended 30 September 2004, showing prime cost and the value at which goods are transferred to the warehouse. And for the year 30 September 2004, prepare the following: trading profit and loss account and balance sheet. Then C, state 2 reasons why company may wish to transfer their goods from factory at a price exceeding. So from what I can see, C, D, and E are theory question. Only A, B, 1 and 2 are, doing the accounts. So then now I know I should prepare a manufacturing account, a trading and profit and loss account, and a balance sheet. So what I'm going to do is I will lay down all my papers. Okay, so without thinking too much, so you should have all your the I mean preferably have your question paper in front of you. So I will do here A, and then manufacturing account for the year ended 30 September 2004, underline. So put 2 columns. You can put your dollar sign here and here, but I've put here, so it's up to you. You should put here and here. Okay, so I leave the whole piece of paper blank. Then, okay, this is my working. You can leave out the working for now first. Okay, then I take another piece of paper. I put here B1, trading and profit and loss account for the year ended 30 September 2004. So I have the whole piece of paper blank. Okay, then I will have B part 2, balance sheet as at 30 September 2004. Okay, in the previous video, I have shown you how to do the balance sheet in the statement format. I have shown you very slowly and clearly how to lay down the balance sheet, okay, from 2 pieces of blank paper in a statement format. So A-level students and also O-level students should do the balance sheet in statement format. You should not do it in this T account format in your real exam. Okay, so the statement format is actually quite simple. Actually, the statement format is indeed actually doing exactly this thing, but do in 2 pieces of paper. So fix all these asset in 1 piece of paper and this one in another piece of paper. Okay, so now we have lay down all our answers. So balance sheet, in order to lay down fixed asset, cost, provision for depreciation, net book value. Then leave about half a page, put current asset. Then in another piece of paper, this one you should write here equity, and then you underline, and then you leave about okay, so you don't know whether you have long-term liabilities or not, but about slightly more than half a page, then you put their current liabilities, then underline. Okay, then do the 2 lines at the bottom of the page. And then also, okay, so this one is a trading and profit and loss account. Okay, then you put sales, and then you leave 2 lines, then you put less cost of goods, so you underline. Okay, okay, so since this is a manufacturing account, there will be a lot of things. So for this question, because this is a manufacturing account under cost of goods, so there will be a lot of things. So you leave about about this amount of space, or maybe you can leave the this whole piece. Then you take another piece of paper, then you put here less expenses. That means it's a continuation. B part 1, then here less expenses, so that you have plenty of space, plenty of lines to space out. So here less expenses. Then after that, then you at the end of the paper you put net profit. So you have lots of space to space out. Okay, so then you have this manufacturing account. So what is this manufacturing account all about? So you see, previously we have done the trading and profit and loss account, where the company actually purchase the goods from a supplier and then they sell it. But now the company, instead of purchasing the goods from the supplier, they have their own factory to manufacture the goods, and sell. For example, a small provision shop, they they would actually buy all their goods from supplier, and then they will sell to the customer. That's how they do their business. But for a bigger supermarket, like Giant or NTUC or Sheng Siong, they are big supermarket. They have their own factory. Some of the factory are in Singapore. Some of the factory are overseas, whatever country, Indonesia or whatever. So they have their own factory, and the factory will manufacture the products, and they will send to the supermarkets for sale. So that means under cost of goods sold. So you have opening stock of finished goods. You see, you will have a factory. The factory will manufacture the goods. Then all the finished goods, they will be delivered to their warehouse. In a supermarket, I can imagine that they have a factory. Then from the factory, they will deliver to the warehouse in the respective supermarket outlet. Okay, for example, a supermarket. So every supermarket, the bigger ones, they do have a warehouse, a so-called a store, a place that would store their newly delivered goods. So that one we call it a warehouse. So then instead of add purchases, we add manufacturing costs, okay, transferred to to the warehouse in the supermarket, okay, transferred from the factory to the warehouse. Then we less closing stock of finished goods. Okay, so now we got to get started. So now we are going to look at the question. Okay, what is this? This is so complicated. So how are we going to start? Okay, so now we look at our manufacturing account. Manufacturing account, it will be like, the factory account. That means the manufacturing activities in the factory. Okay, so this is an account. Um, in other words, is actually the factory account. So the factory account, we are going to look for, we are going to compute our prime cost. What is prime cost? Prime cost is actually primary cost. Primary cost. That means in order for a factory activity, what is the primary cost? What is the most important cost? The most important cost, of course, is the raw material. We should have the raw material. Without the raw material, we cannot produce anything. And then the other primary cost will be the direct cost. Okay, direct production wages. That means the staff who does the production. These these are all the direct costs are actually prime costs. So we got to figure out the prime cost first. Okay. So opening stock of raw material. So how can we find the opening stock, the beginning stock? Okay. So the year ending is 30 September 2004. So this is the opening stock of raw material. So those who don't have the question with you, you should take a screenshot. Those who have the question with you should put the question in front of you so that easier for me to explain. So you take opening stock of raw material in. So according to the question, in the figure is given 36,000. You can put your figures in thousand, but for me I like to put it in full like that. Either way is okay. So add purchases of raw material. Purchases of raw material is also given there. You know where we are looking at here? Purchases of raw material. So we are finding the figures. So once you use your figure, you take a pen and tick. Tick. Yeah. Okay. Then you less returns of raw material. We have returns of raw materials is also given in the question, 6,000. And then less closing stock of raw material here. Closing stock of raw material stock, 28,000 here. Okay. Okay. So then this is our raw material cost that is used in production. then add direct expenses. So production wages is a type of direct expenses. Okay, direct expenses. So then we add this one, we get our prime cost. Then add production overhead. Add production overheads. This manufacturing account is a factory account. So you must identify all the overheads that is relating to the factory. Okay, so we have indirect. So whatever figures that you have used in the question, you tick so that you don't get confused. 58,000 indirect factory wages. Okay, this is 81,000. Okay, so now this one so now, okay, then now what are we going to do? What are we going to do next? Okay, so then the trading profit and loss account, actually, you see, we have laid down all the papers. We can choose to do the things that are easier for us. Okay, so then this one we can hold on first. We can leave a few lines, then we underline. Then we take opening stock of work in progress and less closing stock of work in progress. Closing stock of work in progress here. Okay. You see, work in progress is also in the factory. Yeah. So work in progress is also in the factory. So then you take the difference opening stock and closing stock, you get this one, then you underline. So then this is the cost of production. Okay, you see, the thing is, as a boss of okay, so why don't we leave this one? So we have cost of production, then we hold on first, because I will explain to you the easiest number first. Okay, then we go to the more difficult one. Okay, then we come to this one, trading and profit and loss account. Trading and profit and loss account. So sales, and then less sales return, then you underline, you get net sales. Then you under here you have cost of goods sold. So then opening stock of finished goods. Opening stock of finished goods. The finished goods in the factory is 22,000. Okay, it's stated in the question. Okay, then finished goods in the warehouse. Okay, you have finished goods in the factory as stated in the question, and then you finished goods, stock of finished goods in the warehouse. Okay, so how am I going to get 30,000? Okay, this one can I hold on for a while first? Okay, warehouse. I leave this figure blank. I put here warehouse, and then underline. I leave this. Then add manufacturing cost transferred to warehouse. Okay, manufacturing cost transferred from the factory to the warehouse. Okay, then less cost closing stock of finished goods. Factory. Okay, closing stock of finished goods factory is also given in note 1 of the question, 17,000. Warehouse, okay, I leave this blank first, then I underline. Okay, okay, then I can hold on the rest of the things. You see, expenses is on another piece of paper. Expenses is on another piece of paper. So under expenses, you have selling costs, 31,000, and then you have administrative and salary costs. Depreciation, I hold on first. So I'm putting in all the easy figures first. Advertising, 12,000. Loan interest, 16,000. Okay, so I will put all the easy figures first. So that's why practicing is very important, because by practicing, then you can organize yourself in your own way, and from there you can improve. So fixed asset, I have organized it cost, provision for depreciation, and net book value, and then I will try my best to put in all the figures. Like here, share capital 100,000 is given in the question. So once I use my figure, I tick. And then you have loan stock, right? Loan stock, so long-term liability, loan stock 230,000. Okay, I assume that everybody have gone through all the lessons systematically. Otherwise, you will find it hard to follow. Okay, then add net profit or net loss. So you put your net first. Okay. Then you have retained profit. Okay. Retained profit. 1 October, okay, profit and loss account 1 October 2000. Okay, so this one I can hold on first because I don't know the figure. And then I have current liabilities. Current liabilities, bank overdraft is easy, so I put here bank. Uh, uh, no, bank overdraft is 20,000. Yeah, it's from the question. Then I have creditors 174,000. Okay. Okay, then you have debtors 262,000 as given in the question. Okay, stock is actually given in the note 1, quite easy, 28,000. Then work in progress 45,000. Finished goods at factory 17,000. Okay, finished goods at warehouse. Okay, in under note 2 of the in the question, it says that all goods are transferred from the factory to the warehouse at cost plus 20%. A provision for unrealized profit on stock in a warehouse is maintained so that stock appear in the balance sheet at cost. Okay, now look at this carefully. Look at the question. Okay, so in the question here, it says that there is a provision for unrealized profit on stock, and note 2 explain what is this provision for unrealized profit for. Okay, you see, it's given in the question that all this is the closing stock, and this is the opening stock. So stock at finished goods in the factory is 22,000. Okay, so that means the all goods are transferred from the factory to the warehouse at cost plus 20%. You see, when you have a big supermarket, for example, okay, you have a factory, your factory, some are in Singapore, some are overseas, and then you have the trading stores. How are you going to manage your staff, manage your workforce so that everybody become motivated and everybody is responsible for what they are doing? Okay, so you see, the trading side of the supermarket, okay, the trading the or side of the supermarket, we will have one general manager there in charge of the trading side, and the general manager will be overall in charge of the trading activities of the supermarket chain. And the factory site, okay, there could be a few factories. There will be a general manager in charge of the factory. Of course, the general manager can delegate his responsibility to the individual factory manager of each factory, and so is the trading side. So that means when the factory general manager division transfer the goods to the warehouse in the supermarket, they will transfer as if they are selling their goods to an outsider. So they are actually so you see, the factory, they would also probably sell their goods to other people other than their own supermarket, and also the supermarket side, they could also buy their goods from other supplier other than their own factory. So that means we should treat it as if the factory and um, and the supermarket are two separate division, and like we call it arm's length, you know. So that means even though it's our own company's factory, when they sell to their own supermarket chain, they also sell it at a profit as if they are selling to outsider. Yeah. So that means from the a supermarket, the trading side, when they purchase the goods, they can make a good decision whether they want to purchase from supplier or they want to purchase from their own factory. Okay, if they would rather purchase from other supplier, and then the factory side will also go and evaluate why is our own factory not buying the goods from us, not taking supplies from us. It's because their pricing is after adding the 20% profit, after adding the profit, the factory is actually selling more expensive than other supplier. So that means they treat it as if both are not related. So that means the goods, all goods. So that means when the goods are transferred to the warehouse, they transferred at cost plus 20%, okay, as if they are selling to outsider. So as to manage the division better, making everybody responsible for the profits of the division. So you see, previously I have also explained that when you do your accounts, you totally ignore closing stock. Closing stock, you would, at the end of the year, you will only go and count your closing stock, and then you directly put the closing stock in your profit and loss account and in your balance sheet. So closing stock is out of the equation in the trial balance, but opening stock is actually carry forward from last year closing stock, will be included in the trial balance. Okay, opening stock is included in the trial balance. Okay, so now we are looking for stock of finished goods in the factory. So you see, this is the trial balance for the whole company, which includes the factory and the trading site. Okay, so this is the finished good at the factory. Stock of finished goods in the factory, the opening stock of finished, which is at cost, this is at cost. Okay, stock of finished goods in the warehouse, 36,000. This stock of finished goods in the warehouse, 36,000, is actually inclusive of that 20% profit. Okay, so I know from the trading and the and the factory, they actually profit from the factory actually profit from the trading side. But when you put in the figures for the whole company, um, the finished goods in the warehouse should exclude the profit element, the 20% profit element. Okay, that's why they said a provision for unrealized profit on stock, this 6,000 is maintained so that stock appear in the balance sheet at cost. Okay, so that's why you see the balance sheet are figures that will be carried forward, are balance figures that will be carried forward to next year. Okay, so the opening stock of finished goods in the warehouse is actually a figure that is brought forward from last year. So what is the opening stock of finished goods that is excluding the profit element? Okay, so you see 36,000 will be at 120%. So you calculate 36 times, the cost will be 36 times 100 divided by 120. So the cost without the 20% profit element in the finished goods in the warehouse will be 30,000. Okay, so that's why the 6,000, that how you get 30,000, 36 minus 6 is actually 30,000. Okay, 6,000 is the unrealized profit. Okay, so if you want to look at it this way, so um, the the profit element is 36,000 times 20% over 120 over 120,000. Okay. So this one, the unrealized profit, the balance brought down is 6,000. Okay, it will be transferred to the trading account to eliminate the openings, to eliminate the unrealized profit in the opening stock of the finished goods. Okay, you can actually ignore the workings if you have already understood. So that's why in the under the cost of goods sold here, the opening stock of finished goods in the warehouse is 30,000. So that means I have used this figure because I have taken 36 minus 6. So 36 I've used, and then I've minus 6, and then I've put it into the trading account. Okay, trading account. So that means similarly, these finished goods at warehouse would have included the 20%, because whenever they transfer to the warehouse, they will transfer at cost plus 20%. So what is the cost of the finished goods at warehouse? without the profit element. So it will be 60,000. So that means the profit element will be 60,000 times 20 over 120. So that means the the 60,000 is at 120%. So the profit element is 20%. Okay, so that means the profit, uh, the internal profit for the finished goods at warehouse is 10,000. So that means the closing stock of finished goods at warehouse will be 60,000 minus 10,000 will be 50,000. And so in the balance sheet also same thing. The finished goods at warehouse is 50,000. So that's how I get all the figures of the current asset already. Okay. So this one also I gotten all the figures here. Okay, except this figure not yet. Okay, so that means in the question I have taken care of note 1 and note 2 already. Okay, here number 3, it says that factory building account for 80% of freehold property, the remainder being warehouse and offices. So now we have all the fixed asset, factory, plant and equipment, and then provision for depreciation, and then delivery vehicle. Okay, so why don't we, since we have already laid out here, why don't we come to this section? Okay, then we put in whatever figures we can first. Factory, plant and equipment, the cost is 420,000. Other plant and equipment, the cost is 60,000. Delivery vehicle. Okay, there's a note on delivery vehicle. So we put your delivery vehicle, we hold on first. Freehold property is 250,000. So you put a figure here first. Okay, so what then now the questions says that factory building a, so now we can go to, okay, so the, under note 4 of the question, it says that factory building account for 80% of the freehold property, and the remainder being warehouse and offices. Okay, you see in the manufacturing account, this is a factory account. So that means in the factory account, okay, you will have depreciation of factory, plant and equipment. Okay, so the figure would be 420,000. And under note 5 of the question, it says that depreciation rate for factory, plant and equipment is 10% on cost. Depreciation rates are applied on cost as follows. So factory, plant and equipment 10%. So 420,000 times 10%. Okay, 42,000. Depreciation of factory building. So factory building account for 20%. So factory building account for 80% of the freehold property. So the freehold property is 250,000. Then times 80% is the factory building. So it should be in the manufacturing account under production overheads. Then the depreciation rate for freehold property is 2%. Okay, then this will be 4,000. Okay, then under your trading and profit and loss account, these expenses are your office expenses. Okay, depreciation, plant and equipment, other plant and equipment. You have factory plant equipment and other plant equipment. So all these expenses here are your office or maybe your trading site, not the factory. That means the non-factory expenses. Okay, other plant and equipment is other plant and equipment is 60,000, and then the depreciation rate under note 5 is 15%. Delivery vehicle we hold on first. Okay, freehold property is 250,000. Okay, so 20%, 80% is factory 20% of the factory building, I mean the freehold property 80% is a freehold building, and then the remainder, which is 20%, is warehouse and offices. So times 20% times 2%. Okay, so we have the figures. Then we have delivery vehicle. So now we look at note 4 of the question. At the end of the year, some delivery vehicle were sold and others were bought, but no record of this transaction have been made in the books. Vehicles sold had cost 40,000. Accumulated depreciation is 33,000, and were part exchanged for new vehicle costing 70,000. An invoice is awaiting from supplier for the net amount of 58,000. So before we think too much, it says that an invoice is awaited from the supplier for the net amount due of 58,000. So this 58,000 is something like a creditor, is amount owing to supplier, correct? Amount owing to delivery vehicle supplier. So we should put it under current liability. So some people put it other creditors, bracket delivery vehicle. Or I can describe it as amount due to delivery vehicle vendor, 58,000, and I put it under current liability. Okay, without thinking too much. Okay. So in the question under the trial balance, delivery vehicle at cost is 90,000. Okay. So delivery vehicle. Okay, in the trial balance here, in the question is 90,000. In the question here, delivery vehicle is 90,000. So how are we going to manage this? And then this is the provision for depreciation for delivery vehicle is 64,000. So they are saying that some vehicles were bought, okay? At the end of the year, some delivery vehicle were sold and others were bought. Vehicle sold had cost 40,000. Okay, so you take this 90, take your calculator, 90. So the vehicle sold had cost 40,000 minus 40 is 50,000, and were part exchange for new vehicle costing 70,000. So they so-called they traded in the vehicle that cost 40,000 for a new vehicle for 70,000. So-called, that means, in other words, they sold a vehicle that cost 40,000 and they bought a vehicle for 70,000. Okay, so then you add 70. So that means your ending cost for delivery vehicle is 120,000. So I put here 120,000. I put it in a working. Okay, so you should have another piece of paper here, workings bracket W. So